If you tried to live on $65,000 a year using only the dividends from an S&P 500 index fund, you would need almost $6 million invested. But another portfolio, built around a completely different kind of fund, could produce that same headline income with less than $1 million. So is the second portfolio 7 times better? No. And believing that it is could quietly destroy the retirement plan you spent 20 years building. The amount you need to live off dividends is not one magic number. It depends on what you actually spend, how reliable that income really is, and how much of it you get to keep after taxes. By the end of this video, you'll be able to calculate your own number, and you'll understand the yield trap that makes a smaller portfolio look far safer than it actually is. Before we go any further, we also need to correct one word sitting right in the title of this video: forever. No dividend payment is guaranteed forever. Companies can cut or suspend their dividends, funds can change strategy, distributions can shrink, and inflation can quietly erode what that income actually buys you over time. So the goal here isn't to find some untouchable income stream that never changes. The real goal is to build a portfolio with enough diversification, enough growth, and enough margin of safety that a single dividend cut doesn't wreck your lifestyle. Keep that in mind as we go through the numbers. Let's start by unpacking that $6 million figure, because understanding where it comes from is what makes everything else in this video make sense. The number you need to invest is simply your annual expenses divided by the yield of whatever you're invested in. To keep the comparison simple, let's use a retirement spending target of $65,000 a year, covering housing, transportation, food, and healthcare. Right now, the S&P 500 yields only about 1.1%, which is close to its lowest level in roughly 50 years, mostly because the index is dominated by large technology companies that reinvest their profits into growth instead of paying them out as dividends. At that 1.1% yield, covering $65,000 a year would take close to $5.9 million, which is clearly out of reach for almost everyone watching. So people naturally look for a higher yield to shrink that number, and there are reasonable ways to do that. Move to the dividend aristocrats, the companies that have raised their dividend every year for at least 25 years straight. And the average yield climbs to around 2.5%, which brings your number down to about $2.6 million. Move again to a fund like SCHD, which blends dividend consistency with a moderate current yield around 3.3% as of 2026, and your number drops to close to $2 million. That's still a serious amount of money, but unlike chasing pure yield, SCHD is built to balance current income with the potential for both dividend growth and capital appreciation over time, which matters a lot more than it sounds like right now. Now, here's where it gets tempting. Funds like JEPI, which generate a large part of their distributions through an options-based covered call strategy rather than traditional company dividends, currently pay out somewhere around 7.5% to 8% a year. Run that same $65,000 through an 8% distribution yield, and suddenly your number falls to around $800,000, or more precisely about $812,500, which sounds like the obvious answer if the only thing you're comparing is the size of the portfolio you'd need. 5.9 million, 2 million, or around 800,000, all producing the same income on paper. If that's all you looked at, JEPI would look like the smartest choice by a wide margin. Here's the mistake almost everyone makes at this exact point in the video: comparing portfolio size without comparing the durability of the income behind it. An 8% distribution yield can make $800,000 look equivalent to a $2 million dividend growth portfolio. But those two income streams are not necessarily equally reliable, equally tax efficient, or equally able to grow along with inflation, and the smaller number only wins if that income actually holds up. Start with what JEPI is actually doing. Because part of its income comes from selling call options rather than from company dividends alone, it can generate meaningful cash flow. But that comes with real trade-offs. The fund tends to participate less in strong market rallies since the option strategy caps some of the upside. Its distributions can and do change from month to month, and part of that income may receive a different tax treatment than qualified dividends, which affects how much of it you actually keep. None of that means the fund is bad. It means it's a different tool solving a different problem, and it's not a fair apples-to-apples comparison against a lower-yielding dividend growth-focused portfolio. Zoom out further, and a higher yield in general can be quietly trading away several things at once: slower capital growth, slower future dividend increases, less participation when markets rally, weaker tax efficiency, less protection against inflation, less stable distributions, and often a lower total return over the long run. This is also where a concept called yield on cost gets misunderstood. If you buy a stock yielding 3% today, and the company raises its dividends 7% a year, your income relative to your original purchase price can roughly double within about 10 years. That's a genuinely useful way to visualize how much your income has grown, but don't confuse it with your portfolio's actual current yield or its total return, because the market value of those shares has very likely risen too, which means your real opportunity cost should still be measured against what that money is worth today, not what you originally paid for it. Yield on cost is a progress metric, not a reason to hold on to a weak investment forever. And one more number worth correcting here. You'll often hear that dividends have made up 40 to 44% of the stock market's total historical return, but that figure depends heavily on which decades you measure. A safer, more defensible reference point is that since 1926, dividends have contributed roughly one-third of the S&P 500's total return, with stock price appreciation making up the rest, and that contribution has varied quite a bit across different market eras. The core idea still holds: dividends matter enormously over the long run, but it's worth using a number that can actually survive a fact check in the comments. So if dividing your expenses by the flashiest yield you can find isn't the right approach, what is? Your real number should start with your expected annual expenses, then add a reserve for taxes and irregular costs. Then add a safety margin on top of that. And only after all of that should you divide the total by a conservative planning yield, not just the best case headline number a fund happens to be paying this year. Here's what that looks like with real numbers. Say you expect to spend $50,000 a year. You reserve $5,000 for taxes and irregular costs, and you add a $10,000 safety margin on top, which brings your total need to $65,000 a year. Apply a conservative planning yield of 3.5%, not because that number is guaranteed, but because it provides a more cautious starting point than building your retirement around an 8% headline distribution, and your target portfolio comes out to approximately $1.86 million. That number is less exciting than $800,000, but it's a number built to actually survive contact with reality. Now let's talk about actually getting there, because a target number means nothing without a realistic path to it. Say you invest $800 a month and earn an average total return of 8% a year, with every dividend automatically reinvested along the way. After 10 years, you'll have personally contributed $96,000, and compounding will have grown that into a portfolio worth roughly $146,000. After 20 years, your total contributions reach $192,000, while the portfolio itself could be worth somewhere around $470,000. That's not overnight wealth, and it's honestly not yet enough for most people to retire on. But look closely at what just happened. By year 20, more than half of that portfolio came from investment growth, not from money you personally deposited. Keep going for another decade under the same assumptions, and the portfolio could reach roughly $1.2 million. Increase your monthly contribution as your income grows, and the timeline could shorten further. There's one more piece that quietly determines how much of this income you actually get to keep, and that's where you hold these investments. In 2026, qualified dividends may fall into the 0% federal tax bracket if your total taxable income, everything combined, not just your dividends, stays below the applicable threshold for your filing status. But that doesn't mean every distribution from every fund qualifies for that treatment. Covered call income, REIT distributions, interest, non-qualified dividends, and return of capital can all be taxed differently, which is exactly why the account holding a given investment can matter almost as much as the investment itself. This doesn't mean every high-yielding asset automatically belongs in a Roth IRA. The right placement really depends on the type of distribution, your personal tax situation, and your broader goals, so treat this as something worth researching for your specific numbers rather than a universal rule to copy. Let's bring this all together. Your real dividend number starts with your actual annual expenses, not a generic average. Add a reserve for taxes and irregular costs, then add a safety margin. And the right size for that margin depends on things like how stable your income is, your age, your healthcare needs, whether you have a pension or Social Security coming in, and how much flexibility you'd have to cut spending during a rough market. Some investors land on 20 to 25% above their baseline number, but that's a starting point to adjust, not a rule to follow blindly. Divide that total by a conservative planning yield, not the highest one you can find. Build in real diversification across dividend growth and income-focused holdings, and think about how that income can keep growing over time rather than staying frozen while your expenses rise. So here's the real takeaway. There's no single magic number for living off dividends forever. There's your number, built from your actual expenses, a yield you can trust to hold up, and the right accounts to hold it all in. Comment your target annual income and your current age, and I'll calculate the portfolio target and estimated timeline for a few of you in a future video. And if this changed how you think about dividend investing, subscribe. Because next week, I'm building the exact portfolio I'd start with from zero in 2026.